Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial jungle. And today we're diving into Siddhi Acquisition Corp's latest report. Get ready because this one is all about the crazy ride of a company that is planning a big move, but hasn't quite made it yet. So what is the big story here? It is a snapshot of a company that has been busy raising money and getting ready for a major business combination, but hasn't actually done a deal yet. Think of it as a company with a lot of cash on hand, but still looking for the perfect place to invest it all. Alright, let's unpack this. Siddhi Acquisition Corp, or SDI as you'll see it sometimes, is essentially a special purpose acquisition company, or SPAC. These companies are created with the sole purpose of raising money through an initial public offering, or IPO, and then using that money to buy or merge with an existing private company. It is a way for private companies to go public without the traditional route. This report is for the quarter ending the 30th of September 2025. The company went public with an IPO on the 2nd of April 2025. So much of this report is about what happened right after they got that fresh cash injection from investors. They've registered several classes of securities, mainly Class A ordinary shares, rights and units. These are the building blocks for their public trading. The Class A ordinary shares are what most investors likely own, and they come with voting rights. The rights, well, they're attached to the units and usually give the holder a chance to get more shares later, often tied to the success of their business combination. Now, this is an important check. They've indicated they have filed all required reports. That is good to see. It means they're keeping up with the paperwork. They're not a big established player yet. They're considered a non-accelerated filer, a smaller reporting company, and an emerging growth company. This means they have fewer reporting requirements and can take advantage of certain flexibility, especially with accounting standards. It also tells you they are still in the early stages of their public life. And here is a crucial point. Yes, they are a shell company. This means they exist purely to acquire another company. They don't have significant operations of their own right now. By the end of October 2025, they had about 27.9 million Class A shares and 6.9 million Class B shares. The Class B shares are usually held by the founders or sponsors and often have different voting rights or conversion terms compared to Class A. Let's dive into the numbers, starting with the balance sheet. Think of this as a snapshot of assets, liabilities, and shareholder equity. On the asset side, the big number is investments held in trust account. As of the 30th of September 2025, this account held a whopping $283,244,155. This is the money they raised from their IPO and private placements, and it is set aside specifically to fund their future business combination. It is basically their war chest. Their total current assets, which are assets they expect to convert to cash within a year, were $853,655. This includes their cash and some prepaid expenses. And their total assets reached over $284 million. This is primarily made up of that trust account money. On the other side, we have liabilities. Most of their liabilities are what they call current liabilities, meaning they're due within a year. These include accrued expenses and offering costs. A significant liability is the advisory fee payable at $8,280,000. This is a fee that is essentially tied to the completion of their business combination, and they've recognized it as a future obligation. Similarly, the deferred underwriting fee payable is also $8,280,000. This is a fee owed to the underwriter of their IPO, which will only be paid if they successfully close a deal. Their total liabilities were about $16.6 million. This is really important for SPACs. The Class A ordinary shares that are part of the public offering are subject to redemption. This means that if investors don't like the deal the company eventually strikes, they can often get their initial investment back by redeeming their shares. As of the 30th of September, nearly all of their Class A shares, about 27.6 million of them, were subject to this redemption at a value of $10.26 per S-share. This is a huge chunk of their equity, and it is shown separately because it is not permanent capital until the deal is done and shareholders decide not to redeem. And digging into shareholders' equity, we see a total shareholders deficit of about negative $15.7 million. What does that mean? It means that the total value of liabilities and the redeemable shares is currently greater than the value of the non-redeemable equity. This is common for SPACs before they secure a target company, as a lot of the money raised is in that trust account and initially considered temporary equity. Now, let's look at their performance, or rather their lack of operational performance for now. For the 3 months ended the 30th of September 2025, they reported a net income of $2,842,367. Sounds good, right? But hold on. This income comes almost entirely from the interest earned on the money they have sitting in their trust account. They earned about $2.9 million in interest. Offsetting this was $154,297 in general and administrative costs. So essentially, they made money on the interest from investor funds, but still spent money on running the company while they look for a deal. Looking at the 9 months ending the 30th of September 2025, the picture is different. They have a net loss of $2,807,335. Here, the interest income of $5.8 million was not enough to cover their operating costs, which were much higher in this period, totaling $8,671,490. This includes that advisory fee we saw earlier. For the very early period from their inception in July 2024 through the 30th of September 2024, they had a small net loss of $45,056, mostly for basic administrative costs. This shows how much their expenses increased after their IPO. The cash flow statement shows us where the money came from and where it went. For the 9 months ending the 30th of September 2025, their net cash used in operating activities was $509,070. This reflects the expenses of running the company. Their investing activities show a massive outflow of $277,380,000. This is the money from the IPO and private placements that was deposited into that trust account. They didn't really invest it in a business, they moved it to the secured trust account for safekeeping until a deal. Financing activities show where the big money came in. They had proceeds from the sale of units totaling $275,750,000 and from private placement units for $3,380,000. This is their IPO fund. They also repaid $205,000 on a promissory note from a related party, meaning someone connected to the company's founders or sponsors. Overall, they had a net increase in cash of $758,551 during this period, largely thanks to the IPO. Looking at the notes, we get more context. Siddhi Acquisition Corp was set up in July 2024, and their main goal is to find a deserving business to merge with. They haven't picked a target yet, and until they do, their main form of income is that interest from their trust account. There is a rule that the business they acquire must be worth at least 80% of the money in their trust account. This is a significant hurdle that ensures they're looking for a substantial business. The folks who started the company, their sponsors and directors, have agreed not to redeem their own shares if the deal doesn't go through. This shows their commitment and alignment with the company's success. They're betting on the deal. Their liquidity situation is directly tied to the IPO funds. As of the 30th of September 2025, they had about $759,000 in cash outside of the trust account, which they plan to use for identifying and evaluating potential target companies. They seem confident they have enough funds for the next year, but if their search for a business partner takes longer or costs more than expected, they might need more money. Here we see they follow us generally accepted accounting principles, but as an emerging growth company, they can adopt new accounting standards later than other companies. This can make their financial statements a bit different from bigger, more established businesses. This section reiterates that those class of shares are treated as temporary equity because of the redemption feature. This means they're not considered a permanent part of the company's equity until the redemption period is over or an acquisition is completed. The table here shows how the value of those redeemable shares is increasing over time from the initial issuance price to their potential redemption value. This systematic increase in value is booked as a charge against shareholders' equity. This note details the initial public offering. They sold 27.6 million units at $10 per unit, which included the underwriter exercising their full option to buy more units. Each unit had one class of share and one right. Simultaneously with the IPO, the sponsor bought about 338,000 private placement units, also at $10 per unit, bringing in an additional $3.38 million. These are similar to the public units, but often have restrictions on when they can be sold. This is where we see the founder shares. Initially, the sponsor paid a very small amount for these shares, and they've gone through a few restructurings. These shares convert to class of shares later. There is also mention of a consulting firm affiliated with the CFO providing services and a monthly administrative fee to an affiliate. These are all standard dealings for a company like this in its early stages. It seems they had a loan from the sponsor for expenses, which has since been repaid. This shows flexibility in earlier funding. They mention geopolitical risks like the Russia, Ukraine, and Israel, Hamas conflicts. This is broader economic context that could impact their ability to find and close a deal or affect the market for their target companies. The underwriter received fees, including a deferred fee of $8.28 million. This fee is only paid if a business combination is completed. This is a big incentive for the underwriter to help ensure a deal gets done. Santander, the advisor, is also entitled to a fee of 3% of gross proceeds, which is $8.28 million, contingent on the business combination closing. This section breaks down the different classes of shares. We see the authorized and issued shares for preference, Class A and Class B ordinary shares. The significant part here is how the Class A shares are presented, reflecting those redeemable shares. The founder shares will convert into Class A ordinary shares, usually on a 1-to-1 basis, once a business combination is finalized. This discusses how they value things, especially those rights associated with the units. They use a level 3 valuation, which means they rely on unobservable inputs, like their own assessments of market conditions and the likelihood of a business combination. They have only one operating segment, which is the company itself as it looks for a business to combine with. Their chief operating decision maker, the CEO, looks at the company as a whole. This section is management's own explanation of their finances. They're upfront that they haven't generated any operating revenue yet. Their income is from interest on their trust money, and their expenses are for legal, financial reporting, and due diligence. They clarify that the net income for the quarter was almost entirely from interest on their trust account, and they still had administrative costs. They repeat that the IPO provided them with the funds they need for now, and the next year they are using the funds outside the trust account to scout for potential businesses. They confirm they have no off-balance sheet arrangements, meaning no hidden debts or complicated financial structures. The ongoing monthly fee for administrative support services is noted. This is where they explain how they handle tricky accounting areas, like those redeemable shares. This section is not required for smaller reporting companies, so it is not detailed here. They state that their disclosure controls and procedures were effective, meaning they're doing a reasonable job of ensuring important information is communicated on time. This is just a list of the documents that are part of this filing. Alright, let's get to my take. Siddhi Acquisition Corp is in a very common but high stakes position. They've successfully raised a significant amount of capital, over $280 million, which is great. This capital is mostly sitting safely in a trust account earning a bit of interest, but that is also the risk. They have a ticking clock and limited time to find a business to acquire. If they don't, all that money meant for investment might go back to the shareholders, and the company essentially dissolves. The big expense they have is this advisory and deferred underwriting fee, totaling over $16 million if a deal closes. That is a hefty price for finding a business. Their leadership seems committed as they've agreed not to redeem their own shares, indicating they're confident in finding a deal. The biggest unknown, and frankly the biggest risk, is the successful completion of a business combination at a fair valuation. There is a lot of competition for good acquisition targets, and the market conditions can change drastically. For investors, the key is to trust that the management team can identify a quality business and negotiate a fair deal that will create long-term value beyond just getting their initial money back. Right now, their financials look like a company that is waiting, with the main financial activity being the investment of their own capital rather than business operations. It is all about execution from here. Alright, that is our breakdown of Siddhi Acquisition Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more community insights. See you next time.